All right, so now we're going to jump into other types of non-cash transactions, or at least things that include non-cash elements. And so we're going to start with issuance of equity securities. And so, a lot of times when you have a smaller business, you might have a new owner or a new partner join a company, and instead of like buying shares, they might contribute something like a tangible or intangible asset, maybe land, patent, some sort of contribution. Sometimes it might be cash too, but they're going to have these elements of non-cash contributions. And so, how do we handle a transaction where basically somebody's giving up ownership in exchange for some sort of assets? And so again, you have this issue of you don't have cash to anchor on. So, do you use the value of the equity or to use the value of the asset? And the reality is sometimes it's not clear. And so accountants have to use their judgment when it comes to what items should drive the transaction. For publicly traded companies, it's a little easier because obviously if Microsoft were to acquire some smaller company, Microsoft and gave them stock. Let's just say they acquired it using Microsoft stock. I mean, hopefully it's very clear that, the value of Microsoft's stock is very, very, very reliable. But when it's not something like that, it becomes way more complicated. And so we're going to do an example here that's a little more complicated than the book example, just to kind of, challenge ourselves a little bit and also just kind of really highlight how this works. And so they're bringing in, so 49 company, they're bringing in a new capital market, new capital partner to its mining business. And so the partner is providing $5 million cash. So there is cash that's part of this transaction, but they're also giving them 800 acres of undeveloped land and a copyright. And of course, we know, undeveloped land and a copyright. I mean, we might be able to estimate those values, but it's not going to be clear necessarily, at least not as clear as cash is. And then in exchange for that, 49 Company is going to give them 40,000 shares of its stock. Now, 49er estimates that the fair value of its stock is $650. The value of the patent is 3 million, and the value of the land is $25,000 per acre. Now, again, you use the value of what you give up unless the value of what you receive is clearly more determinable or clearly more reliable. And so in this case, 49 Company believes that the value of its stock is clearly less evident than the value of the land and the patent, and that the land and the patent are equally reliable. And so in this case, because of that little note, it's going to change the way we do the transaction. So rather than the value of the equity driving the transaction, the value of the patent and the value of the land, along with the cash, of course, is going to drive this transaction. And so let's do the journal entry given that information. All right, so what did we receive? Well, hopefully it's easy. We received cash. That's easy. We received the patent, which we estimate is $3 million. And we received land, which is estimated to be $25,000 an acre, times 800 acres means the value of the land is $20 million. And so again, because these items are clearly more evident than the value of the equity, these items are going to drive the transaction. And so we bring the cash, the land, and the patent onto our books. And then it might sound kind of silly, but we're just going to plug in the common stock number. Essentially, what we're saying is the $650 per share is not reliable, or it's not as reliable as these other items. And so we ignore it for the transaction. And so again, under US GAAP, you just kind of choose a side. The default is what you give up unless the items that you're receiving are more clearly evident. In this case, the items that we received, we thought were more clearly evident. All right, donated assets doesn't happen that often, but let's say that for some reason, a company received some asset and it was a complete donation. There is nothing that they want in exchange for it, and it's just a free exchange. Now, here's the issue. Obviously, in this case, that item that you're receiving, that's the only thing that can drive the transaction because you're not giving them anything in exchange for it. And so you're just going to have to estimate the fair value. So it's a fairly simple transaction. But I'd say the only thing that's not clear is what's on the other side of that transaction. So I like to walk through a little bit of a logic exercise. So if I receive a donated item, a piece of equipment or land or whatever, or vehicle, um, that is going to be a debit, right? I'm receiving some sort of asset. And so really what we're looking for is a credit. And so there are different options when we think about that. One would be a decrease to an asset, but hopefully you realize that, well, in this case, that's not really what's happening. I'm not giving up some sort of asset. I might have a liability that I didn't have before, but again, when there's a donation, you don't owe anybody anything. I could see where you might go down the contributed capital trail, but just understand those are supposed to be transactions with owners. And if somebody's donating land or whatever, like a true donation, that's not contributing anything. They're not acting as owners. It could decrease in expense. In other words, I consume some asset and this is like offsetting that somehow. But hopefully you realize that's not really the case either. And so really we're left with an increase to revenue. And so it's going to be some sort of revenue or gain account. So IFRS, they record a donation as a gain. But for US GAAP, we really follow nonprofit organization or nonprofit accounting, and they're going to re record that as either donation or contribution revenue. So in a very easy example, 400 acres of land is donated to the state of North Carolina, and we're basically saying, okay, or donated from the state of North Carolina. And so 49er company needs to figure out, well, how do I record this donation? Assuming that they valued the land at $10,000 per acre. Hopefully it's pretty straightforward. It's just a $4 million transaction. You bring the land on at its est sorry, estimated fair value, and then you record that as donation revenue. Now, really, where we're going to camp mostly here is in this exchange. All right, so there are many times where there is a non-monetary asset exchange. Now, you might include a monetary element like cash or a note or something like that. But there's a significant part of the transaction where it's just one asset's being exchanged for another. And so a very common one is if I operate a fleet of vehicles, a lot of times I use vehicles and then I trade them in for new vehicles, right? So there's just this, trade-in process where I give you my old vehicles, you give me new vehicles. Now, of course, most of the time, I'm going to have to give you something more than just my old vehicles because they're not going to be worth as much as the new ones. But we kind of walk through how we do that. And so there's really a four-step process. One is you record the new asset at its fair value. So you estimate that asset. What is the fair value of that asset? You could use it for vehicles, might use MSRP, or might actually negotiate the price and say, okay, well, here's the price that we assign to that asset. And then you got to remove the book value of the non-monetary asset given. Now, I want to be clear, this isn't reflecting the fair value of the asset that we're giving up. So this has nothing to do with what I get for a trade-in or anything like that. It's just saying what was the value of that asset on your books. And so there was an original cost that you paid, and there's the accumulated depreciation that you would have recorded over the life of that asset. So you're going to take both of those items off of your books. And so, of course, the asset's coming off with a credit, and the accumulated depreciation is going to come off with a debit. And so that's what's going to come off your books. And then there's going to be sometimes in one of these transactions, you might receive cash, or you might have to pay cash, or there might be like a note, which is basically in lieu of cash, right? So basically, I will pay you cash in the future. And so you got to include that. And then almost always, there's going to be a gain or a loss because it very rarely will happen where the book value of my asset that I had on my books is exactly equal to the value that the person on the other side of the transaction is assigning it as its fair value. So the only way that you wouldn't have a gain or a loss is if the market value and the book value of the asset that I'm forfeiting is exactly the same thing. Now, again, very unlikely to happen. And so since the market value is driving the transaction, you're going to have a gain or a loss almost all the time. And so let's kind of walk through this example. So Fortner Company exchanged 10 used vehicles for 10 new vehicles on June 10th, 2025. The total cost of the new vehicles is 450,000. Or used vehicles, the original cost was 450. They had accumulated depreciation of 350, and the market value of the new vehicles is 500. Now, in addition to exchanging the vehicles, the company signed a $300,000 note. And just assume it's at the market rate of interest. So how would we record this? Again, step one is you bring on the new vehicles at their fair value. We said the new vehicles, had the market value of 500,000. So whether that's MSRP or whatever, whatever negotiated price you had for those vehicles, that's what would sit there. And then what you do is you take off the old vehicles, right? So I happen to just use a different number. Could you have used the same one? Maybe. I mean, probably honestly, you'd have like 160-1 or 160-2 or something like that, or take it into the thousands. But either way, you're taking the old vehicle off, which is the original cost, and of course, the associated accumulated depreciation also needs to come off the books as well. So again, accumulated depreciation is a contra asset, so it's in the hundreds. I did have to pay a note, or I gave them a note of $300,000, which is a promise to pay. So that's a liability. And of course, then there's a difference here between our debits and our credits. And that difference goes as a gain on the asset exchange. And so that $100,000 difference, if you notice, the value of what I received, or the net value of what I received is more than the net value of what I gave up. So therefore, we had a gain. And so just to kind of formalize that, the gain is the difference between the book value of the old vehicles, which is 100,000, again, 450 minus 350, the book value of the old vehicles, and the present value of the note for a total of 400,000. That's what I gave up. And what I got in exchange was worth $500,000. Therefore, we had a gain because we received more than we gave up, as far as on our books. Now, as far as, just sort of a thought exercise and answer these questions, if you want to pause the video and think about these, that'd probably be a good idea. But, what if what if the note had been for $400,000 instead of 300, which based at that point, excuse me, um, I would have given up a total value of $500,000, because 400,000 plus the book value of the asset. It would have been $500,000 and $500,000. So there would have been no gain and no loss. But at $450,000, I would have, in that case, I would have been giving up more than I received. And in that case, I would have a loss. And so you just have to kind of think theoretically, did I give more did I give up more or did I receive more? If I receive more, it's a gain. If I give up more, that's going to be a loss. Small additional issues, if for some reason you cannot determine the fair value of anything, then you just use the book value of the assets that you gave up to value the transaction. And then finally, you could have a situation where there's a lack of commercial substance. So the idea here is, if I own a piece of land, let's just use that as an example. And let's say that I had a piece of land where I originally purchased it for $1 million, but the fair value had increased to 4 million. The only way that I can recognize a gain is if I sell the land, right? So if I sell it, then or exchange it for a different asset, then of course I can recognize that gain. Now, let's say that for whatever reason, let's say I had a relationship with a bank and they would facilitate basically land exchanges. A situation where, I give up my 10 acres and you give me the 10 acres right next to it, sort of as an even exchange. Well, in that case, following what we just showed, I would take the old land off my books at 1 million and bring the new land on my books at 4 million, and I'd have a $3 million gain. But what US GAAP says is, well, if I'm exchanging basically two identical pieces of land or identical assets, then there's really no commercial substance. You're just creating a paper gain. And US GAAP says you cannot recognize that gain if there is really no commercial substance. So how do we define commercial substance? In other words, how would we determine this? And the answer is if my future cash flows changed due to the exchange. So in this case, if I own this 10 acres of land or I own that 10 acres of land, that's not really going to change anything, right? It's still 10 acres of land, relatively, basically the same land. And so there's no change in my future cash flows. And so there would be no commercial substance. There's no gain. So, but US GAAP would allow you to recognize a loss. So if you want to do that exchange and recognize a loss, they would allow that. All right, that's it for this one. And we'll be jumping into actually the next chapter next.